Hello, this is Monica Sawyer. Welcome to Real Estate Investing for Women, where we focus on all aspects of real estate investing, including strategies, mindset, emotional mastery, money smarts, and so much more to ensure your success. If you'd like to learn my personal favorite investing strategy, just go to blissfulinvestor.com. You can also listen to this episode on the Real Estate Investing for Women podcast on iTunes. Now, let's welcome our guest. Before we get going on today's show, I'd like to chat with you about becoming your own bank. If you're planning to finance your next real estate venture through a bank or mortgage company, I have one word of advice for you. Stop! You could become your own source of financing and recapture all that interest you would otherwise pay and never see again. Imagine being able to get the money you need, when you need it, and have the power of being a cash buyer at closing. Take back control of your financial future and go to amazingwomeninrealestate.com. You'll receive a free report on how you can bank on yourself rather than greedy banks and mortgage companies. You can also request a free strategy session from one of our favorite guests on the show, certified financial planner Mark Willis or Amanda Neely, or one of their colleagues who are experts in providing custom-tailored strategies for your real estate ventures. Take your business to the next level, whether you're just starting out or adding another 100 doors to your portfolio. Go to amazingwomeninrealestate.com. Today, I am so excited to invite to the show Amanda Hahn. As both a tax strategist and real estate investor, Amanda combines her passion for real estate investing with her expertise and knowledge in tax strategies. Her goal is to help investors with strategies designed to supercharge their wealth building using entity structuring, self-directed investing, and income offset opportunities to keep more of what they make. Amanda's highly rated book, Tax Strategies for Savvy Real Estate Investors, is amongst Amazon's bestseller list. And that's actually how I found Amanda and why I invited her to the show. I was really impressed with this book. Amanda is a frequent contributor, speaker, and educator to some of the nation's top investment and self-directed IRA companies. Amanda's cutting-edge tax strategies have been featured in prominent publications including Money Magazine, Realtor.com, and AllBusiness.com. Amanda was a speaker at Talks at Google that feature influential thinkers and creators and has appeared in CNBC's Smart Money Talk Radio as well as on BiggerPockets podcast. Wow, that is quite a bio, Amanda. Welcome to the show.
Thank you so much for having me, Monique. I'm really excited to be here.
Yeah. So, just tell us a little bit about your story.
Yeah. So I am actually a third generation real estate investor in my family, but I don't have the traditional story. A lot of your listeners might have read Rich Dad, Poor Dad.
Yes.
And so I kind of grew up with both a rich dad and a poor dad, and it was the same person. So my grandparents were real estate investors. My parents were real estate investors. But they really did not talk me into real estate. In fact, they had me go to college, get a good job. And so I worked as a CPA in a large firm for many years, essentially giving strategies to other investors and paying a lot of taxes myself. And so it wasn't many, many years until after I was working there that I read the Robert Kiyosaki book. And I realized that, hey, you know what? These strategies are really working because I see that every day as a CPA for the clients I was working on. And so my husband and I remember we're just sitting in bed one day, and we just said, you know what, let's start investing in real estate. Why not, right? Start somewhere because we paid a ton in taxes all these years. And so I got into real estate. And so it was an interesting thing. I always tell people, I'm a third generation real estate investors, but I didn't learn about real estate from my family at all. I had to go outside, get my own education from books and podcasts and things like that. But I'm so glad I did.
Yeah, that's so interesting. And I kind of had a similar experience, not exactly the same. Like my parents are also real estate investors.
Yeah.
But they also were like, the way to make it is you have to go to college, get your
Yep.
degree, right?
Yeah.
Get a good job, save your money, maybe invest on the side, right?
Yeah.
And so that was kind of the strategy that I used for a long time until I was able to take it full time. But it is really, really interesting sometimes that even investors are sort of like, no, don't do this thing.
Yeah.
It's hard, right?
Right, exactly, exactly.
Yeah.
Yeah, I remember when I was really young, for apartment turnovers, my cousin and I would go and paint the apartments and mess around at the same time. So I thought it was a lot of fun.
Yeah, it is fun, right? Well, it's fun for some of us. I think there are a lot of people like, I would hate doing that. And there are definitely options, but it's really cool that you're enjoying it.
Yeah, yeah, definitely.
So talk to us about kind of what we can legally deduct as real estate investors. Do you get this question a lot?
I do. It's so interesting because I meet investors from all over the
Mhm.
US, and one of the most common questions I get is, what can I deduct, right? People want to minimize taxes, but they just really don't know what's tax deductible. And as a CPA, when I do tax returns, I always see people write off. If they're a landlord, for example, they'll write off their mortgage interest and property taxes and things like that. Those are rarely missed. But what I often see missed are the overhead items that are business expenses, but not necessarily specific to a property. So common examples would be, traveling to a real estate conference, or even, going to a local real estate meeting, driving there, having dinner before, after, and or even buying a book about taxes or about investing. So those are things that I see missed all the time. And I think people just either they tend to forget that it's a deduction, or they're unsure whether it's deductible just because it's not necessarily tied to a specific property. So that's what I see time and time again. I think there are a couple myths out there in terms of what are deductible. And I think the easiest thing I always tell people is ask when you're spending money, ask yourself this question: this money I'm spending, is that something that's reasonable for a real estate investor to need, right? So we talked about, meals and travel and meetings and things like that, but even paper, pen, supplies, stamps and things like that. So just keep in mind, those are things that are, all potentially deductible. But I think one of the biggest mistakes I see people make is having this thought process that I can only deduct a real estate expense is if I have a legal entity, like an LLC or an S corp or things like that. And that's actually not true at all. The IRS does not care whether you have a legal entity or not. What they look at is whether that expense is a normal and necessary expense for a real estate investor, right? So,
Mhm.
I mean, I always tell, like, for the ladies who like to go to the spa, for example, in order for that to be a tax deduction, I mean, you really have to have an underlying business reason for it. And if you do, that will be deductible whether or not you paid with an LLC money or with your actual cash. So on the flip side, just because you have an LLC, it does not automatically mean that all of your personal expenses become deductible just because you pay for it from the LLC bank account. So I think that's probably the most common question that I get, time and time again. Just like, I want to save taxes, but I don't know what I can write off or what I can't write off. And I think that's what your tax advisor is there for too. That's what we tell our clients. If you're spending money on a big item, let us know beforehand, and then we can kind of help you plan. Is it deductible? And if not, are there things that could be done to turn it into a legitimate tax deduction?
I love that. And I think it's so important to get a tax consultant that really understands real estate investing. Because I've had tax consultants that said they understood real estate investing. And what that meant was they had two clients that invested in real estate. And so they had done quite a bit of research on all the deductions, but they weren't living it.
Hmm.
So I just recently switched over because of this podcast. I have met the most amazing people because of this podcast. But because of the podcast, I switched over to a CPA that is tax specific. That's all they do is real estate investors. And I know that you're very heavy with real estate investors also. Um, but he told me things like, "Oh, Monica, why are you not deducting your mileage to each of your properties when you go do inspections or fixing things up or whatever?"
Right.
Well, my gosh, I've been an investor for 25 years and nobody else has said that. Like, really? Do you know what I mean? So it is
Yeah.
important to get in touch with someone like Amanda or someone that understands real estate investors and the specifics. Like, that's such a basic thing. Why was it not caught in the past?
Yeah.
Do
And,
you know
I
what I
think,
mean?
yeah, and I think real estate investors, we almost have like a different lingo too, in
Mm-hmm.
what you talk about for, refinancing and closing disclosures and things like that. So we have clients that when they first work with us, like, oh, you know exactly what I'm talking about. I don't have to go through and explain. But yeah, I think that's definitely key in seeking out a tax advisor, is making sure that, they have a good number of real estate investors, so that you don't want to be the one that they're researching, right? It's like,
That's
well,
right.
you're my first real estate person. Let me research about what is depreciation, what is a write-off, because then you're just someone's, test case, if you will.
Beta, yeah, exactly. They're guinea pig. And what I really love about someone that is specific to real estate is I don't have to justify write-offs. Like, I don't have to say, no, I really do use my home office for real estate. Like, that's where I call my tenants from. That's right. Like,
Yep.
oh yeah, I only buy these pens for that. You know what I mean? Like,
Right.
I don't have to justify any of that stuff.
Right.
Which is really amazing. It's such a time saver and such a heartache saver.
Yeah.
So, Amanda, where are you located?
We're located in Southern California
You
in
are? Okay.
Fullerton. Yes.
Okay, great, great, great. And do you do taxes all around the country, or how does that work for you?
Yeah, we do actually. So, because of the book that we wrote, we have a lot of people that find us through online forums and Amazon.
Mm-hmm.
So, now more than half of our clients are actually out of state, so
Oh,
not local to us. So, yeah, I mean, for our clients, everything nowadays can be done email, Skype, video conferencing. So all of those are great ways that we can keep in touch with our clients. I mean, in fact, this is such an interesting story because, Southern California is known for bad traffic.
mm-hmm.
And so I have clients who will travel here to meet with me because I happen to be the same exit as Disneyland. So
Oh, yay!
a lot of clients like to come and, happen to also go on a family trip, and, why not make it partially deductible too, right? Or even
Right.
fully deductible. And so we oftentimes, especially around now in the summertime months, we have a lot of clients from out of state that fly in, meet with us, and, go on vacation at the same time. But I have my clients that are, in LA or San Diego, which may be only 30, 40 minutes away. They don't want to drive in because of the traffic.
Totally makes sense.
Yeah, so it
and
just
it's
depends.
and it's so convenient. Zoom calling, it's just so much easier, just in general.
Yeah, definitely,
So
definitely.
perfect. So, Amanda, you mentioned something about tax reform. Could you talk a little bit more about sort of how that applies to different kinds of investors and what that really, because I know that there's been a lot of fear around that. I think
Yeah,
now that we've been through one tax season with all the new reform, I think people are calming
yeah.
down about it. But I'd love to hear your input around that.
Yeah, I mean, tax reform is interesting. So many things have changed. I think a lot of people were kind of anticipating what the ultimate change was going to be.
Mm-hmm.
But I think that for individual taxpayers, certain things were taken away, which, did end up being the greatest of changes. However, for real estate investors, I have to say all of the changes, I mean, dare I say it 100%, if not 100, maybe 99.9% of the changes were in favor of real estate. And so,
Thank you so much for pointing that out in that way. Because investors are like, oh my gosh, all of my benefits as an investor. No, no, no. It's actually the exact opposite.
Yes, exactly. And that's a common misconception because under the tax reform, some of the things that were starting to be limited or taken away were mortgage interest and property taxes. And so there's a lot of fear among investors because those are two big items that we deduct.
Mm-hmm.
But the key is to understand that those limitations were taken away from primary homes and individual taxpayers and not from investment. So if you're a landlord You could still deduct 100% of your mortgage interest, 100% of your property taxes, all of these out-of-pocket expenses that we were just, chatting about earlier. And so none of that was taken away. Refinancing interest, all of that is still deductible against all of, rental and maybe even other income too. So that's a good thing. Again, nothing was taken away. But in addition to things not being taken away, we also have additional write-offs that we can take advantage of. So we have a 100% bonus depreciation, and that's really great for real estate investors because, if you're purchasing a computer for your home office, some office, chairs, or if you're furnishing your investment properties, whether it's appliances or if you're doing Airbnb type of stuff and buying, bedding or furniture, those are eligible for 100% bonus depreciation, which in a simplified format just means you can write off 100% of the purchase price of those items immediately when you spend the money. And that's true even if you don't spend the money. If you were to put it on credit card, that is still deductible as well at the point when you charge that expense. So that's a really great one. I think one of the more commonly talked about items under tax reform was the flow-through entity tax break. Essentially what it was a break that provided a 20% tax-free money. And so what that means is, if you have certain types of income, let's say you made $100 of income, under tax reform, the first $20 of that is completely tax-free. So you pay no taxes on $20 and you only pay taxes on the remaining $80 of income that you earned.
And is that only if you are an entity, or is that for sole proprietors or whatever also?
Good question. And that was the thing that we really hated about the media referring to it as a flow-through entity tax break, because that's the question people were saying, oh my gosh, I don't have an entity. Do I get to utilize it? And then we have attorneys out there saying, you got to form an entity right away. But the reality is, no, you don't have to have any entity. Okay, so just because you have one, you still could be eligible. But even if you don't have one, if you're a sole proprietor or just the landlord owning properties in your own name, you still could be eligible for that 20% tax break. So it doesn't have as much to do with entities as it does with what type of income. So the good news is for real estate investors, maybe we can go through some common real estate income. Most common is rental income, right? So for the majority of landlords, 20% of that rental income could be tax-free. Otherwise, for real estate investors, you might have maybe someone who's a realtor, for example, right? Selling, making commissions and things like that. So commissions income also eligible for the 20% tax-free treatment. If you made, again, $100 of commissions income, rental income, the first 20 could be at zero tax. I think some other common ones, if you're someone who's doing fix and flip, wholesale, if you're not notes, but, fix and flip, wholesale, those are also eligible for the 20% tax-free. The one that's not eligible, unfortunately, are note investors. So if you're someone that is, lending money to other people, generally what you're earning is interest income, and that's not eligible for the 20%. There are times, though, when even note investors could get that 20% tax break. Generally, it happens when you are very actively involved in note investing, almost kind of like you're in the note investing business, if you will, right? So doing lots of notes or doing a large volume of notes, then that could rise to the level where you could potentially also have 20% of that income to be tax-free.
So really what you're distinguishing between here, and these are some terms that my listeners may have heard kind of out and about in the world, but I know we haven't talked a huge amount about it here on the podcast, is passive versus active investing income, right? And so is that correct? Am I using this correctly, or just correct me?
Yeah, yes and no. So even passive income could be eligible for the 20% tax break.
Okay.
We'll take the example of a real estate investor, right? A landlord. So rental income is generally going it could be active or passive. But even if you're someone who's working full time, let's say you have a handful of rental properties that you're investing in on the side, you still could potentially have that rental income to be eligible for the 20% tax break. What is not eligible are W-2 income. Okay, so again, if you're working working full-time, investing part-time, your rentals might be eligible, but your W-2 still will be fully taxed, just like in the past.
Of course. Okay.
The other type of income that's not eligible would be what they considered investment income. So which typically are, capital gains from the sale of stocks, interest, like your money at a bank earning interest income, as well as dividends. So dividend payout from stock investments. Those are the three common ones that are not eligible. So the distinction is more so, between earned and rental income being eligible versus investment stocks types of income not being eligible.
Okay. Okay. Interesting. So when you were talking about if you lend out your money and you're earning interest,
yes.
How would you classify that income?
Yeah, so it just depends. If you're someone who is doing one or two notes here and there, it's just the same as if you put your money in a bank, right? So that would be considered interest income, in which case it would be not eligible, right? Whether you're lending to doing private notes or just putting money at the bank, essentially. Now, we do have clients who are active note investors, meaning that's all they do is note investing. That's their main income that they get. And so sometimes if they get a huge amount of interest, then what we can do is we can show that as active income, as if they're earning it as their job, if you will. And so in that scenario, that becomes earned income, where they rise to the level and they are able to utilize that benefit.
Okay. And just to backtrack a little bit, the 20% is basically what they do is say you make 100% income, they take off that 20% and then you're only taxed on the 80%. Is that what that looks like? Okay.
Yeah. Yes.
Okay.
So it's it could be a huge benefit, right?
Yeah.
Depending on how much income. We used $100 as an example, with $20 being tax-free. But if you had $100,000, then $20,000 of that is tax-free, right? So that could be a $10,000 tax savings right there, depending on what your tax rate is.
Very cool. Awesome. Cool. Yeah, I'm learning so much. So don't hesitate to correct me on these things, because I don't know. That's why we hire people like you, right?
Exactly. And there's so many interesting things about tax reform that are still changing. The IRS is actually, believe it or not, still coming out with clarifications. Rental income for one. Before, we were all under the assumption that everybody gets to utilize the 20% discount against all rental income. And then they came out with some new language, and then people were saying, oh my gosh, no investors can get rental income because that's almost just like interest. And a couple months later, they came out and said, okay, well, you could be eligible or you could not be eligible. It depends on how much time you're spending or your property managers and people are spending. And so they're still coming out with more clarity. But I think, again, the good news is that for the vast majority of real estate investors, there are more benefits than there are detriments, right?
Got it. And this, ladies, is why you want to hire a professional. They've had it like every few weeks. They come out with new information about tax reform. So there's just no way for us to keep up with it all. And the reality is that at the end of the year, when we're trying to go through taxes, who knows what you were going to be able to know? You don't have the depth of experience that a CPA would have. So always hire pros to do the things that are not your normal profession. Right? Or that you don't want to become an expert at. Like, I don't want to become an expert at that. I don't have the time, right? So,
Exactly. And I think, the best time to plan to minimize taxes is actually during the year. Because if at the end of the year or in April the following year, if that's the first time you're talking to your tax advisor, odds are it might be too little too late. So, we're talking earlier about even capturing expenses. If you know today what is tax deductible, then you can go back to January and try to figure out what those items are. And for the rest of this month or this year, you can, make sure you're getting your receipts, that you're jotting down all of the business deductions. Now, if you're contemplating the sale of real estate, we know real estate market has been pretty hot. And, if you're selling real estate, you're looking at paying a lot of taxes for capital gains. Well, if your CPA doesn't know that you've sold the property until next April, odds are there are very limited things you can do to minimize taxes because that transaction is already done. But if you are talking to your tax advisor before you sell the property, then they can look at, how do you maximize your write-offs? What are some, additional things you can deduct? Can you do maybe a 1031 exchange to defer the tax or, reinvest that money in other ways? So yeah, I think the best time to talk to your CPA is definitely before you enter into any significant transactions. And also, earlier in the year, just so that you know what to plan for, right? And you can still do those things before the year's over.
Yeah. Awesome. Could you talk a little bit about income shifting strategies for the savvy investor?
Yes, for the savvy. I know, I love it. So income shifting is such a technical term, but the way we look at it is how can you take a tax deduction for money that you are paying or giving to other people anyway? And I think the easiest concept we use as an example might be your kids, right? So, kids, for those of us who have kids are probably one of your biggest expenses, right? Besides taxes. And so, and especially when the kids get older too, right? Older kids are more expensive. When they're babies, you give them a piece of paper, they can play for hours and hours. When they're older, they want video games, and even older, they need cars and shopping and all that. And so the question just becomes, okay, we're giving our kids money for them to spend. Are there ways to legally take a tax deduction for it? So generally speaking, if you buy your child a car or you're giving them allowances, that's just all personal expenses. We don't get to write off any of it. Now, as real estate investors, if you're a savvy investor, you put your creative hat on. And so the question becomes, okay, can we have our kids help us out in our business? And then we would pay them for helping us in our business. Then they take that money and they can use that to buy a car, or that will be their allowance. The tax benefit, though, is instead of just giving them money, because we're paying them to help us out in our real estate, that becomes a legitimate business deduction, right? So whether we pay our kids to help us or we pay John Smith to help us, those are both business deductions because we're paying someone to help us to further our real estate investing. So that's a really great strategy because, again, it's not saying to pay someone to spend money for deduction. It's to take a deduction from money that you are already spending anyway. So, finding hidden deductions on everyday things that you're spending money on. And, if currently you can pay, not just your child, but anyone, the first roughly $12,000 of income is not taxed at all. So if, let's say you had a daughter who's 15 and, helping you out with your podcast or, your investment. If you're an investor, they're helping you with, door hanging or door signs and things like that. If you paid them even $6,000, that you might be saving $2,000, $3,000 in terms of taxes that you were otherwise just paying to the IRS anyway. Right. So we really love that. Now, especially in today's aging population, I am seeing a lot of clients that are not just helping out their kids financially, but also helping out their parents financially too.
Isn't that amazing, right?
Yeah, it's the sandwich generation, right?
Yeah, absolutely. I'm right there. Yeah.
And so, so the same strategy could be applied, if you're helping out your parents financially too, right? Instead of, paying for mom, if mom's retired and receiving very little Social Security, maybe have mom help you out in the business and, shift income that way as well, where, even if she's already paying taxes, you might be able, let's say she's only in the 12% tax bracket, but you're in the 37% tax bracket. That's still a pretty big difference in terms of overall family tax savings. Right. So that's something to consider as well. A question I get a lot is, how old do my kids have to be before I start shifting income to them?
Yes.
And the example I give is, you've seen diaper commercials, right? Where cute babies crawling around. And so there are there's no IRS restriction in terms of how old the kids have to be. They do require that the compensation is reasonable for what they're doing. So if you have a, again, 14, 15-year-old, they're probably more computer savvy than we are. So it's probably reasonable to say that you can pay them a lot of money. If you have a 2-year-old, that's your IT, IT specialist, probably not going to make a whole lot of sense. So it's really just, looking at what's appropriate for their age. And, if you're someone who happens to have older kids who've gone away to college, maybe have moved back, in between jobs, you can still pay them as well. If they've moved back home and they're not really working at any other high paying jobs, maybe you do want to put them to work anyways to help you out in your real estate, and at the same time take a tax deduction for it.
Mm-hmm. That's awesome. Thank you for bringing that up. I know a lot of people that do that, but we don't talk about it that much. So thank you so much for that.
Yeah.
So Amanda, this has been so good, and we've got more to come, but we're almost out of time on this part of the show. So the next two things that we were going to talk about, which is how to maximize your travel costs and strategies to pay yourself rather than the IRS, we'll take both of those in the extra section, okay? But for now, could you tell my guests how they can get in touch with you and tell them about your free gift?
Yeah, definitely. So we can be reached on our website. It's www.keystonecpa.com. And our office number is 877-975-0975. And so if you check out our website, we have a great downloadable free ebook, and it talks about a tax strategy specifically for real estate investors. And the website again is www.keystonecpa.com.
Perfect. And we will have that in the show notes. So you guys can look it up there, and I'll put the phone number in there too. Thank you for offering that. That was very generous.
Yeah, you're welcome.
So Amanda, are you ready for our 3 rapid fire questions?
I hope so.
You're so funny. They're easy, I promise.
Okay.
Okay, so number 1, what is one super tip on getting started in real estate investing?
Super tip on getting started. I think with anything, I think just do it. I mean, once you have a decent amount of general understanding of real estate, I think is kind of pulling the trigger and just take the first step and actually, if you're investing in notes, make your first note investment. If you're buying rental properties, start making offers and, closing on properties. I know, thinking back to when my husband and I bought our first rental property, it was really scary. I still recall that. It's kind of like, as we were signing paperwork, I didn't know if I should jump out of the window and just, end this whole thing. But it gets easier, right, with the second property and third property. So I think in terms of getting started is just, starting the process. Don't get caught up in overanalyzing, or, thinking about too many different types of real estate. So, from a tax perspective too, it's definitely helpful. A lot of people don't know this, but IRS rewards people who take action first. As an example, if this year you spent some money to learn about real estate and you start investing in real estate right away, odds are you can write off all of those expenses. But if you're someone who's been thinking about real estate, but you're taking classes, you're learning, and 2 years go by, still no real estate, all of those are considered startup costs, and you actually have to amortize them over many years. You can't write them off immediately. So I always tell people, start today. Don't wait until tomorrow.
God, I love that. Thank you so much. And the way that you put that, it's so true. If you're holding expenses for a long time, that's money that you can't write off. That's money that you're not getting access to.
Right.
So
Exactly.
That's really amazing. Thank you.
Yes.
And then what is one strategy on being successful in real estate investing?
One strategy that's successful. I mean, this might be a little bit biased because I'm an accountant. I think for me, one strategy in being successful is looking at the numbers. I think for all of us, especially for the ladies, we look at stuff. Maybe we tend to fall in love with houses, right? If you're looking at rental properties and you say, oh, this is great. This is a nice master bathroom. Maybe I will move in here when I retire. And that's a big trap. Do not fall a victim to that trap. If you're going to be a landlord, for example, look at the numbers. What is the income? What are the projected expenses? If the numbers make sense, then those are the properties we're considering. Don't put yourself in those shoes. Don't put yourself in that big closet or the bathtub, because that may or may not be what makes money, and that may or may not be what the tenants make. So always, make a decision, make a financial decision for the investment and not a personal decision.
That's awesome. Thank you. And what would you say is one daily forgive me, what is one daily practice that
Mhm.
contributes to your personal success?
One daily practice. So what I like to do is I like to take action as soon as possible, and if I don't take action, um, I schedule that on my actual calendar. So, I know a lot of people have to-do lists where, you kind of have a list of things that you're doing today or a list of things you're doing tomorrow. If there's something that very important to me, for example, invitation to be on today's show, I schedule it right away. I'm not going to delay that till tomorrow, the day after. Or if it's something where I can't schedule it right away, then it's on my calendar maybe for tomorrow. So that tomorrow at 9 o'clock, the time is already there. I'm going to schedule with Monica and, prep myself and all that. I think for me that helps quite a bit because, again, you don't want to delay, right? Whatever it is, investing, business, education, when it gets here, you kind of want to get it done sooner rather than later.
That's perfect. Thank you so much for that. And thanks for all that you've offered on this part of the show, Amanda. It's been amazing.
Thank you so much for having me.
Sure. And listeners, thank you for joining Amanda and I for this portion of the show. We do have more coming on Extra. So if you are subscribed to Extra, stay tuned. We're going to be talking about strategies to pay yourself rather than the IRS and how to deduct travel. So I'm really excited about that conversation. If you're not subscribed to Extra but would like to be, you can just go to realestateinvestingforwomenextra.com and you can subscribe there. For those of you who are leaving me right now, thank you so much for joining us for this portion of the show. I look forward to seeing you on the next show. And until then, remember, goals without action are just dreams. So get out there, take action, and create the life your heart deeply desires. I'll see you next time. I hope you enjoyed today's show. If you'd like to download my favorite investing strategy, just go to blissfulinvestor.com. See you next time.